In order to grow your wealth, which is the better strategy? Investing in real estate or stocks? Or maybe both? Many Americans actually do a bit of both. 65% of the US households are owner-occupied, according to the US Census Bureau, and the Bureau of Labor Statistics say that 55% of American workers participate in an employer retirement plan. If you're among them, you've likely had some exposure to the stock market. But if you're looking to double down on either type of investment, or if you're new to investing and trying to pick between the two, it's wise to know the advantages and disadvantages of each strategy. Hello, my name is Max Monan, I'm a real estate agent in Portland, and let's get right into the age-old debate of real estate versus stocks. Before that though, please be sure to like the video if you're enjoying it so far, it does really mean a lot. And definitely be sure to subscribe as well if you enjoy personal finance and real estate related content. Anyway, let's get into it. First, let's talk about investing in real estate. Traditional real estate investments can be broken down into two broad categories: residential properties, like your home, rental properties, or houses that you're flipping, and also commercial properties such as apartment complexes, office buildings, and strip malls. Let's first talk about the pros of investing in real estate, and the first pro today is that there's lots of ways to finance. There are many different ways to finance a property that you want to buy. These ways can include cash, hard money, private money, portfolio lenders, partnerships, 203k loans, FHA loans, traditional mortgages, commercial loans, home equity lines of credit, and much more. In comparison to stocks, where you really shouldn't get any type of loan for investing in the stock market, having a loan when investing in real estate can be extremely smart. Number 2 is that real estate investments can serve as a hedge against inflation. Real estate ownership is generally considered as a good hedge against inflation, as home values and rents typically rise with inflation. Number 3 is tax benefits. Now, I'm definitely not a CPA and this is not legal advice, but there are some great tax benefits when it comes to real estate. Let's talk about a few. One is repairs. You can generally write off repairs and maintenance needed on rentals as long as they're deemed ordinary and necessary. For example, if you hire a contractor to fix a roof, that cost can be written off as a business expense. Number 2 is travel expenses. Travel expenses to do with the rental property you can actually write off, and this includes public transportation and Uber if needed. Number 3 is property tax. All property tax based on the percentage of how much the rentals take up can be completely written off. For example, if you own and live in an identical duplex and rent out the other side, you can write off 50% of the property tax for the entire property. Number 4 is depreciation. Now, if you're in residential real estate, you just divide the value of the building, not the land, by 27.5. Then you multiply this by the share of the building dedicated to rental activities. For example, if you own and live in an identical duplex and rent out the other side, you would multiply this number that you found earlier by 0.5. The next tax benefit is interest on the mortgage. You can write off the amount of interest you pay for the rental properties in a mortgage entirely. Next one is a home office. If you dedicate a room to be an office space to deal with your properties, you can write off all costs associated with it. This includes, but isn't limited to, the property tax in the area it takes up, the interest on the mortgage of the area it takes up, depreciation of the home, and all the items in the room that are required for working can be written off. The second to last one that I want to talk about is business expenses. Anything and everything that has to do with running a business can be written off. So this includes but isn't limited to a computer, a printer, internet, a phone, a desk, and all of these things can be written off as a business expense. Lastly, I want to talk about insurance premiums. For example, if you decide to get earthquake protection included in your home insurance and you're renting out the other side, half of that cost can be written off. Another pro for investing in real estate is building equity. If you use a traditional mortgage, every payment you make on that mortgage slowly gains you more equity in the property by paying down the principal. This means that every time your renter is paying their rent, they're helping you gain equity in the property, meaning even more money for you. Another benefit is what's called sweat equity. Basically, you can work as much or as little into the properties that you have, meaning that you can increase the value of the property by just working on it yourself. If you want to do your own repairs on the property, you can increase the value of the property by a lot more than what you're spending, especially if you're doing it on your own. The second to last pro is flexibility and creativity in every aspect. Don't have a lot of time outside of work to deal with the property? Hire a property manager. Love doing construction work? Do some of the renovations yourself. Don't have a lot of money? Find a partner to buy the property with you. Real estate offers a lot of flexibility, so you can work to your strengths while having other people do things that you don't really have the time for or just don't want to do. With real estate, you can, for the most part, set your own schedule. And lastly, it's the possibility to buy below market value. When negotiating for a property, you don't usually buy the property for its initial price unless the seller is extremely adamant or the property is getting a lot of interest. This varies depending on the area and how many offers there are on the property and how long it's been on the market, etc. But generally you can get a deal on properties below market value, and that is just not possible with stocks. And now let's talk about the cons. Number one is that real estate investments can be more work than stocks. While purchasing a property is easy to understand, that doesn't mean that the work of maintaining properties, especially rental properties, is easy. Owning properties requires much more sweat equity than purchasing stock or stock investments like index funds. Next is that real estate is expensive and highly illiquid. Investing in real estate, even when borrowing cash, requires a large upfront investment. Getting your money out of a real estate investment through resale is much more difficult than the point-and-click ease of buying and selling stocks. Number 3, it's that real estate has high transaction costs. A seller can expect to pay significant closing costs, which can take as much as 6 to 10% off the top of the sales price. That's a hefty cut compared with stocks, especially now that most brokers charge no fees for stock trades. Second to last on the cons is that it's difficult to diversify your investments with real estate. Location matters when investing in rental real estate, and sales may slump in one area while values explode in another. Diversifying your purchase of real estate properties by location and type, a mix of residential and commercial for example, requires much more deeper pockets than the average investor has. And lastly, your return on your investment isn't a sure thing. While property prices tend to rise over time, there's always a risk of selling a property at a loss, and the 2008 financial crisis is a reminder of that. This is also true of stocks, of course. Now let's move into the pros and cons of investing in stocks. First, the pros. Number 1, stocks are highly liquid. While investment cash can be locked up for years in real estate, the purchase or sale of a public company shares can be done the moment that you decide it's time to act. Unlike real estate, it's easier to know the value of your investment at any time. Number 2, it's easier to diversify your investment in stocks. Few people have the time, let alone the money, to purchase enough real estate properties to cover a broad enough range of locations or industries that have true diversification. With stocks, it's possible to build a broad portfolio of companies and industries at a fraction of the time and cost of owning a diverse collection of properties. Perhaps the easiest way, which is purchasing shares in mutual funds, index funds, or exchange-traded funds. These funds buy shares in a wide swath of companies, which can give fund investors instant diversification. Another pro is that there are fewer, if any, transaction fees associated with stocks. While you'll need to open a brokerage account to buy and sell stocks, the price war among discount brokers has reduced stock trading costs to $0 in most cases. Many brokers offer a selection of no transaction fee mutual funds, index funds, and ETFs. The second to last pro is that you could grow your investment in tax-advantaged retirement accounts. Purchasing shares through an employee-sponsored retirement account like a 401k or through an individual retirement account can allow your investment to grow tax-deferred or even tax-free, which simply isn't possible with real estate. And lastly, it's simple. To be transparent, investing in stocks can be extremely simple and quick, especially when compared to investing in real estate. You can set up a Roth IRA with a brokerage and automatically contribute a certain amount every single month to an S&P 500 index fund, all in less than 20 minutes. This makes investing in stocks very lucrative for people who have little to no time to work on it. And lastly, the cons. And number 1, it's that stock prices are much more volatile than real estate. Prices of stocks can move up and down much faster than real estate prices. That volatility can be stomach-churning unless you take a long view on the stocks and funds you purchase for your portfolio, meaning you plan to buy and hold despite volatility. Number 2 is selling stocks results in capital gains tax. When you sell your stocks, you may have to pay a capital gains tax. If you've held the stock for more than a year, however, you may qualify for taxes at a lower rate. Also, you may have to pay taxes on any stock dividends on your portfolio paid out during the year. And lastly, stocks can very easily trigger emotional decision making. While you can buy and sell stocks more easily than real estate properties, that doesn't mean you should. In fact, you really shouldn't ever be planning to sell stocks for a long time when you're investing for the long term. When markets waver, investors often sell when a buy and hold strategy typically produces greater returns. Investors should take a long view of all their investments, including building a stock portfolio. In conclusion, both stocks and real estate investing have their own pros and cons and can both be amazing ways to build wealth. You can succeed with both, and I would recommend having a mix of both in your own investment portfolio. Now, thank you all so much for watching. I hope you learned a thing or two about both real estate and stock investing. Please don't forget to like the video if you liked it. It does take quite a bit of time to make each video. And definitely be sure to subscribe for weekly real estate and personal finance related content. Until next time, bye.